Welcome to the Wealth Architecture series. Today, we are diving deep into one of the most critical yet often misunderstood topics in the world of personal finance. We are calling this the Tax Arbitrage Masterclass. Specifically, we will be mastering the dynamics between traditional 401k and Roth accounts. Many people mistakenly believe that retirement planning is just a simple game of saving as much money as possible in any account they can find. However, the reality is far more nuanced. True retirement planning is not just about saving, it is about making a calculated bet on the timing of taxation. You are essentially deciding when you want the government to take their piece of your hard-earned pie. Are you better off paying taxes today at your current rates, or are you better off waiting and paying whatever the rates might be 30 years from now? Throughout this presentation, we will break down the math, the strategies, and the common traps so that you can navigate these decisions with confidence. By the end of this session, you will have a clear framework for how to optimize every dollar you earn and ensure that you keep as much of your wealth as possible. Let us begin this journey into the mechanics of tax arbitrage. To understand the core concept of tax arbitrage, we should look at the parable of two farmers. This simple story illustrates the fundamental difference between the traditional and Roth strategies. On the left, we have Farmer A, who represents the traditional approach. Farmer A puts his corn into a government-protected barn today and gets to deduct his taxes immediately. He does not pay any tax on the seeds or the growth while they are in the barn. However, he agrees to pay the taxman a portion of the harvest when he finally takes the corn out in the future. This is a winning strategy if current tax rates are higher than future tax rates. On the right, we have Farmer B, who represents the Roth approach. Farmer B pays her taxes at the gate today before her corn even enters the castle. Once inside those castle walls, her harvest is marked as tax-free forever. She pays no tax on the growth or the final harvest. Farmer B wins this bet if current tax rates are lower than future tax rates. The most important lesson here is that the ultimate winner is not determined by the investment returns because both farmers can achieve the same growth. Instead, the winner is determined solely by whether the tax bite is larger today or tomorrow. It is a game of relative percentages. Let us look at the mathematical reality behind these two paths by examining what we call the atomic unit of wealth, which is a single dollar of earnings. Suppose you earn $1 and you have a 24% tax rate. You have two distinct paths you can take. In the top path, which represents the traditional account, you pay no tax now and invest the full $1. If that investment doubles over time, it becomes $2. When you withdraw that money and pay a 24% tax at the exit, you are left with $1.52. Now let us look at the bottom path, which represents the Roth account. You are taxed 24% immediately, which leaves you with only 76 cents to invest. If that 76 cents doubles over time, it also becomes $1.52. Because it is a Roth account, you keep the entire amount tax-free. Notice that the final net result is exactly the same. This proves a very powerful point. If your tax rate is the same today as it is when you retire, the outcome is identical. Therefore, you are not really betting on the growth of the money. You are betting on the difference in the tax rates. The traditional strategy assumes your rate will drop in the future, while the Roth strategy assumes it will rise. Now we move into the concept of the bucket theory, which explains the real arbitrage opportunity found in the difference between marginal and effective tax rates. When you contribute to a traditional 401k, you are saving taxes at your highest marginal rate. This is the very top bucket of your income, where every dollar is taxed at the highest percentage. For example, you might be saving 24% on every dollar you put away today. However, when you retire and start withdrawing that money, those withdrawals do not immediately hit that top 24% bucket. Instead, your withdrawals flow into your tax return from the bottom up, filling the lower tax brackets first. You might save 24% today, but your average or effective tax rate upon withdrawal might only be 11.5% because much of that money is filling the 10% and 12% buckets. This spread between saving at a high marginal rate and paying back at a lower effective rate is the essence of tax arbitrage. It allows you to keep a much larger portion of your total wealth simply by being strategic about the timing. You are essentially harvesting a tax subsidy from the government by utilizing the progressive nature of our tax system. This is how savvy investors build massive wealth over time. The foundation of any great tax strategy is what we call the zero tax foundation. This is built upon the fact that the IRS gives every filer a standard deduction. This is a specific amount of income that you can receive every year without paying a single penny in federal income tax. Currently, for a married couple, this amount is around $29,200, while for a single person, it is $14,600. This is what we call the bedrock strategy. You need to have enough traditional assets to withdraw approximately $30,000 per year if you are married just to fill this 0% space for free. If you do not have enough traditional assets to fill this space, you are essentially leaving money on the table because you are not taking advantage of the 0% tax bracket. Even if you are a huge fan of Roth accounts, your first priority should be filling this zero tax space with traditional withdrawals. This ensures that you get a tax deduction at your high working years rate and pay 0% when you pull it out in retirement. This is the ultimate win in the world of financial planning. It is about building your retirement income from the ground up, starting with the most efficient dollars first before moving into higher tax territory. While we want to maximize our traditional withdrawals, we must also be aware of a dangerous trap known as the tax torpedo. This phenomenon is caused by the way Social Security benefits are taxed in the United States. High withdrawals from traditional accounts increase your combined income, which is a specific formula the IRS uses to determine how much of your Social Security is subject to tax. As your traditional income rises, it triggers a chain reaction that can cause up to 85% of your Social Security benefits to become taxable. This creates a hidden spike in your effective marginal tax rate. For example, taking just one extra dollar of traditional withdrawal can effectively cause another 85 cents of your Social Security to be taxed. This means you are not just paying tax on that $1. You are paying tax on $1 and 85 cents of total income. This is why having too much income coming solely from traditional accounts can be a massive disadvantage. It effectively torpedoes your tax plan by significantly increasing your tax burden in the middle of your retirement years. To avoid this, you need a diverse mix of income sources so that you can keep your reportable income below the thresholds that trigger this expensive chain reaction. Balancing these sources is the key to maintaining a low lifetime tax bill. Another danger that many retirees overlook is the hidden cliff of IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is essentially a spike in your Medicare premiums based on your reported income from 2 years prior. Imagine a scenario where you are right at the income threshold of $106,000 and you suddenly have a lumpy expense, like a $2,000 home repair. If you take that $2,000 from a traditional account, it increases your reported income and pushes you over the cliff. This small increase in income can trigger a surcharge that adds over $1,100 to your annual Medicare costs. This means your $2,000 repair actually cost you over $3,000 once you factor in the penalty. However, if you have Roth assets available, you can pull that same $2,000 out without any increase to your reported income. In this case, there is no surcharge and no cliff. Your Roth assets act as a shock absorber for these types of lumpy expenses, keeping you safe from unexpected tax cliffs and premium spikes. This level of control over your taxable income is one of the most valuable benefits of having a significant Roth bucket. It gives you the freedom to spend money when you need it without fearing the government reaction. To manage all of these moving parts, we use the optimal mix framework. You should think of your retirement income strategy like a high-end audio soundboard with various sliders that you can adjust. Your first slider is the base load, which consists of traditional withdrawals. You use this to fill your standard deduction and the lowest tax brackets like the 10 and 12% ranges. This ensures you are getting the most value out of the lowest possible rates. The second slider is your tax-efficient layer, which primarily includes your Social Security benefits. Finally, you have the cap slider, which is made up of your Roth assets. You use the Roth bucket to cover any excess spending needs or large one-time purchases that would otherwise push you into high tax brackets or trigger the surcharges we have discussed. The key takeaway is that you should not choose just one type of account. A successful strategy involves using traditional funds to fill the low tax floor buckets and using Roth funds to cap the high tax ceiling. This combination gives you the maximum amount of flexibility and ensures that you are always paying the lowest possible rate on every dollar you spend. By balancing these three layers, you create a robust and resilient financial plan that can withstand changes in tax law and unexpected life events. As you move through your working life, your strategy should change based on your current earnings. We call this shifting gears through your career. When you are early in your career and your income is relatively low, typically in the 12 to 22% tax brackets, you should shift your gears toward Roth contributions. At this stage, your goal is to lock in these historically low tax rates while your earning potential is still growing. As you reach your peak earning years and find yourself in the high income brackets of 24 to 37%, you should shift your gears toward traditional contributions. This allows you to maximize your immediate tax deduction when it is most valuable to you, effectively banking the tax arbitrage. There is also a third gear called Roth conversions. This involves moving money from traditional accounts into Roth accounts during years when your income is temporarily low, such as during a career break or in early retirement before you start taking Social Security. This allows you to move money into the tax-free bucket while tax rates are at a local minimum. The fundamental rule is to always match your contribution type to your current tax bracket relative to what you expect your future tax bracket to be. By being proactive and shifting gears as your circumstances change, you can significantly reduce your lifetime tax liability. If you want to truly accelerate your path to wealth, you need to understand how to turbocharge your strategy using matches and backdoors. One important concept is the natural hedge. Even if you choose to put all of your own contributions into a Roth account, almost all employer matches are currently placed into traditional accounts. This provides you with automatic tax diversification without you having to do anything extra. It ensures you will always have some traditional assets to fill those low tax buckets we talked about. For high earners who want to go even further, there is a secret weapon known as the Mega Backdoor Roth. While the standard employee contribution limit is $23,000, the total limit for all contributions is $69,000. High earners can use after-tax contributions to fill that remaining gap and then convert those funds into a Roth account. This allows you to funnel up to $46,000 of extra money into a tax-free environment every single year. This is a massive advantage for anyone looking to build a substantial tax-free nest egg quickly. Understanding the specific rules of your employer plan is the first step to unlocking these advanced techniques. When you combine the natural hedge of employer matches with the aggressive funding of the Mega Backdoor, you create a powerful engine for long-term wealth accumulation that is difficult to beat. Finally, we must consider the impact of our choices on our legacy and estate planning. Tax laws regarding inherited accounts have changed significantly with the introduction of the 10-year rule. This rule requires most heirs to fully distribute the assets from an inherited retirement account within 10 years of the original owner's death. If you leave a large traditional account to your heirs, those withdrawals will be stacked on top of their own income during what are likely their peak earning years. This could subject your hard-earned savings to a tax rate as high as 37%, causing the inheritance to literally crumble under the weight of taxes. However, Roth assets are a completely different story. They transfer to your heirs 100% tax-free. While your heirs still have to follow the 10-year rule and empty the account, they can let the money grow for the entire decade and then take it all out without paying a single cent to the IRS. This makes the Roth account the mathematically superior vehicle for wealth transfer if you do not plan to spend all of your money during your lifetime. By choosing Roth, you are essentially giving your loved ones a gift that is protected from the reach of the government. It ensures that your legacy remains intact and provides the maximum benefit to the next generation. To help you make a decision today, we have developed the decision matrix. This simple logic tree helps you determine where your next dollar should go based on your current marginal tax rate. If you are in the 10 to 12% tax brackets, your priority should be to lock in those low rates by contributing to a Roth account. If you are in the 24 to 37% brackets, Your priority should be to bank the arbitrage by contributing to a traditional account and taking the tax deduction now. If you find yourself in the 22% bracket, you are in the decision zone. In this zone, you should lean toward traditional if you expect to have low spending in retirement, but you should lean toward Roth if you expect to have high required minimum distributions or other high income sources later. There are also important override factors to keep in mind. If you have a very high net worth or a strong legacy goal for your heirs, you should consider switching more of your strategy to Roth regardless of your current bracket. On the other hand, if you are currently in a high tax state and plan to move to a state with no income tax in retirement, the state tax arbitrage makes the traditional path even more attractive. Use this logic tree to make your contribution election for the current tax year and stay on track. In conclusion, achieving financial success requires adopting the tax arbitrage mindset. You must remember that this is a dynamic process, not a static one. Tax laws will change, and your income will fluctuate over time, so you must be prepared to adjust your strategy annually. You should view tax diversification with the same level of importance as you view your asset class diversification. Having money in different tax buckets gives you the ultimate flexibility to choose where your income comes from as the political and economic landscape changes. Your ultimate goal should not be trying to pay $0 in tax today, but rather paying the minimum possible tax over your entire lifetime. By staying informed and flexible, you can ensure that you are always making the most mathematically sound decisions for your future. The ultimate win is having the freedom to choose which tax bucket to use as the world around you changes. Please share your feedback in the comments. We love hearing your ideas for future videos as well. If you find this useful, please share, like, and subscribe. And smash that notification bell to stay updated on our latest content. Thanks for watching, and see you in the next video.